Well, my basic thesis today is that gold has re-entered the global financial system and therefore needs to be repriced. After 80 years of price manipulation and an explosion in fiat currencies and paper assets. So, slide please. So, we are now have been for 80 years on a dollar standard since 1944, Bretton Woods, which is now ending. The dollar standard was advanced by the US government's strong dollar policy, um, another word for manipulation. And gold is returning to its role as the only real money, quote, as everything else is credit, said JP Morgan in 1913. Next slide, please. So, what was the strong dollar policy? Well, it consisted of a number of very specific things. First, creation of the petrodollar with the Saudis, who agreed that they would only take dollars for their oil in 1974. Creation of the COMEX futures market in 1974 was a way to play the gold market, trade in gold, but never take delivery and always end up with a dollar profit. IMF got involved and prohibited gold as a national currency in 1976 in the Jamaica Accord. The IMF limited disclosure requirements for central banks. So basically, you didn't have to tell people that you loaned all the gold out. Paul Volcker took on inflation and saved the dollar in 1980 and sent gold into a 20-year spiral downward. Gold was demoted to a tier 3 asset in the first Basel Accord in 1988. And then we had the orchestrated sales of European central bank gold from 1988 to 2000, ending in the famous Brown bottom. That was Gordon Brown, the Chancellor of the Exchequer, who actually auctioned off all his gold in a manner designed to get the lowest possible price, and he succeeded in doing so. Next slide, please. So, what are the consequences of the dollar standard? Well, the dollar is good as gold replaced free market gold, which doesn't have a central bank, in trade and investment. The dollar standard gave the US what the French love to call an exorbitant privilege to spend and sanction at will. The US could finance huge trade and fiscal deficits with impunity. In fact, they used their huge trade deficit to cycle money back to look after their huge fiscal deficit. A very nice maneuver for them. Treasuries became the global standard for central bank reserves and collateral, and the US could control international trade and finance via SWIFT, which is a dollar system for linking banks, a international banking platform. Next slide, please. Consequences number two, an enormous explosion in paper assets. So we'll just take US credit market as an example. From 1971 to 2024, it went from $398 billion to 102 trillion. That's a 256 times increase, or a little, just about 10 times the increase in the economy that the credit was issued against. It's an enormous increase in unbacked paper. It's not backed by the economy because if you tried to convert that to goods and services, you'd be way short. M2 money supply also grew faster, about 50% faster than the GDP. So that's what you do without a gold standard. You get a massive increase in unbacked assets. Next slide, please. Third consequence of the dollar standard. People started to throw in the towel on the dollar. So the BRICS central banks are now selling treasuries to buy gold. BRICS nations are buying energy with their own currency, with final settlement in gold. China and Russia have established alternatives to SWIFT, so their own platforms for interbanking. between banks. Gold is now a tier one asset. Basel III changed its mind, and it's now a preferred collateral. And China is moving to a gold backed yuan for convertibility. This one's really interesting because they're now issuing gold warrants. And for those who are historians of the financial system, back in the 19th century, there were gold backed bills of exchange. That's how you did trade. Now they have gold backed warrants issued by China for its trading purposes. The only difference is, of course, they're electronic now, so they're a lot easier to transfer. Next slide, please. So the value of gold must rise by multiples. Why? Because everything else has. U.S. gold reserves only cover 5% of M2 and 3% of U.S. debt. Just for reference, in 1971, when the U.S. defaulted on the gold standard, at that time, it had 25% coverage of M2 money. So, yeah, 5 times, well, maybe. A dollar backed by debt is a very low confidence dollar. And that's what it's backed by now. The Federal Reserve's balance sheet is treasuries and mortgage backed securities. That's why central banks and foreigners no longer want to hold treasuries and other debt, US debt. Foreign owned US debt is 14% backed by gold versus an historic average of 40%. That used to be required to give foreigners confidence to own your debt. And finally, US 14 trillion of available physical gold can't back global supplies of 483 trillion of paper assets in a crisis. There's just not enough. Now, there actually is $27 trillion of above ground gold, but about half of that is in jewelry, and it's not readily available, not tradable. Next slide. So back to the future. We're going to have to reprice gold to be the active asset again that it is, and the backstop to everything that matters in the financial system. Gold is once again the best protection against uncertainty. Uh, Even Morgan Stanley thinks so. Gold's price will not be set by 80 years worth of the dollar standard. You can't reference a gold price based on those 80 years when it was manipulated. You're going to have to look back in time in order to look forward into the future for the gold price.